I just bought shares in this UK small cap stock. Renew Holdings provides essential engineering services to maintain and renew the UK's ageing infrastructure. But shares are down 23% over the past year, so let's take a closer look. At the latest share price, Renew Holdings has a market cap of £657 million. The company has £8 million of cash on its balance sheet and £20 million of debt, so the enterprise value is £668 million. Meanwhile, the company has generated £1.1 billion of revenue over the past 12 months, £45 million of net income, £83 million of ebitda, and £39 million of free cash flow. So the stock is valued at 15 times earnings, 8 times ebitda, and 17 times free cash flow. Renew Holdings delivers mission-critical services across 4 segments: rail, infrastructure, energy, and environmental. These are non-discretionary services with a total addressable market of £33 billion. That is much larger than the company's current run rate, and it's supported by the UK government's commitment to spend £725 billion on infrastructure over the next decade. That spend will include renewal of existing infrastructure as well as new projects like wind farms and nuclear. Renew's business model involves acquiring capital-light, growing service businesses, a model that has proven highly successful. Revenues have compounded at 8% a year over the past 10 years. Operating margins have steadily improved and net income has grown 23% a year. As a result, Renew Holdings reports an impressive 27% average return on capital employed. There should be more growth to come. The company's backlog is at a record £908 million, and a recent acquisition indicates a willingness to expand into Europe. Solid free cash flow and low debt provides plenty of firepower for deals. If there is a concern with Renew Holdings, it's the unstable finances of the UK government. Renew stock fell 22% in January on news of delays and deferments in Network Rail's Control Period 7. Revenue and margins will be affected by this, but they should eventually bounce back. And management said that full-year operating profit should still come in ahead of last year. There are a couple of different ways to value Renew Holdings, and most point to upside. For example, if you assume that Renew grows its net income at just half its historical rate over the next 3 years, and then you give those earnings an 18 times multiple, the company would be worth just over £1 billion in 3 years' time, which works out to an investment return of 14% a year. More generally, the company currently trades at less than 10 times operating income, which seems too cheap given the company's defensive quality and its ability to compound earnings. But these are my personal opinions, not financial advice, and I do own shares in Renew Holdings. For more investing ideas, make sure to join my newsletter at 3minutebreakdowns.com. Thank you for watching.